not something that can be predictable in advance. But in every market, and this could be equity, credit, real estate, you have people. And wherever there are people, you have emotions. And wherever there are emotions, you're likely to have people's emotions swing like a pendulum between fear and greed, between optimism and pessimism, between depression and excitement. And this movement of this pendulum is based on emotion. Cycles are simply created by excesses and correction. When people get excited, they buy, they invest too much money. An asset is worth 500,000, but in an excited market, someone says, I'll pay 525. Someone else comes, says, I'll pay you 550 to sell it to me. Someone else comes and pays 590, and suddenly, within a short period, the property is sold for 650. However, the intrinsic value is only 500. The original price was 500. So in this case, you see that you've gone to an excess. This excess only occurs in combination with emotions. It only occurs where there is availability of capital. In other words, people are happy to loan you or lend you money. It occurs where there's very little risk, where there's very little perception of the potential for loss. So in this case, you say people are not risk prudent. So whenever you have the availability of capital, the absence of prudence, the willingness to take risk, you will have excesses. And at some point, and I should say very importantly, where you have cheap financing, you have excess purchase. And at some point, it would correct. And then there'll be fear, despondence, depression, anxiety, a sense of loss. At this point is greed. And at this point is fear. And therefore, people would say, well, I want to sell this for 570. Someone else comes and says, I'll take it for 550. Someone else says, just pay me 500 and have it. And so the prices of this, or the price of an asset will fall. In real estate is no different. So, in order for you to know how to finance and to fund your investments, an appreciation of the market cycle is necessary. You might say, well, I don't know how to evaluate when there's too much capital, and I do not know how to know when people are being prudent, and I do not know how to ascertain when people are willing to take too much risk. I would tell you that the easiest to observe is the availability of capital. Today, the risk-free rate is almost zero, and this means that for most banks, it's costing them almost nothing to borrow money. But if you were borrowing using debt, I said that it would be roughly 3.5%. And if the cost of debt is only 3.5%, there's an easy way to know what this represents. You always have to compare what is presented to you to the historic precedent. And that means you can look back and say, well, what was the cost of borrowing over the last 50 years? If you look at both numbers, this is the risk-free rate, this is the risk-free rate plus what we call a default spread, which is the risk of the default. This is the bank will charge you 3.4%. in case you default, but the Bank of England borrowing rate is 0.1%. If you look through, or if you look through the last 50 years, what you find is that the Bank of England borrowing rate has never been this low. This is the lowest in history. Simply means that the cost of funding using debt is the cheapest it's ever been in the last 100 years. And therefore, this tells you automatically that capital will become very available. And because capital is available and because it's cheap, it's like free money, people will become less prudent. And therefore, people will be willing to take very high risks. It's quite easy to understand. Now, if you're about to purchase a property and you're using debt, you go to a bank, they will present you with options. They give you an interest rate. They give you a duration. These are the two things that the bank will always offer to you. They ask you, how long do you want the loan to be for? 30 years, 35 years, 20 years, 25 years. You get to choose. They give you two options of interest rates. Do you want it to be fixed? Do you want it to be variable? I'd like you to, please, if you could, just pay some closer attention to this section, because this is where I see a lot of people make very, very serious lifetime mistakes. Most people would always go for fixed rates. That's what the bank wants you to take. It used to be that if the rate was, default spread was 3.4%, and if you go back 2 years ago, or maybe go back before the 2008 financial crisis, you would have been paying roughly about 2.5% for the risk-free rate, because this was the rate of borrowing from the government in terms of a government bond. This would be the rate of interest you would earn from, say, a 10-year government bond, which is a long-term government bond. This would mean that in total, your cost of capital or your cost of debt will be 5.9%. Today, this is almost next to zero. And therefore, you're paying 3.5%. From the bank's perspective, they want security. And what most banks would do is they would always encourage you to take the fixed rate. And the reason is simply because if you take a 2-year fixed, after the first 2 years, it reverts back to the variable rate going forward. So this could be, it starts from 3.5%, and after 2 years it goes to 4.5%, for example, plus the Bank of England borrowing rate. What most people do is they get you hooked on a cheap repayment interest. And what most people will do is every 2 years, they'll fix it again. And they'll keep fixing it, which would mean that your original principal is never paid down in much. So for a 35-year mortgage, you're paying down this principal at a very slow rate. It's very simple. Your principal payment is simply comprised of the total amount of money you've borrowed. This amount is charged at a certain interest rate, 3.5%. So you would pay the principal plus interest. This will give you a total payment. If you can pay this principal down quickly, the interest you would pay over the duration of the loan will be less. However, the bank recognizes that people like cheap financing, and so they would go for a fixed rate, and after the first 2 years, they would go back to the bank and say, well, can we have that cheap rate again? They'll fix it again, and they'll keep doing this, so the principal is seldom paid down over the duration, and therefore you just keep paying interest over a much longer period. And that's the reason why you might find a house for 500,000, you might take an 80% loan to purchase the property, 400,000 in this case. For most people, what they might find is over the entire duration of the loan period that they've been paying so much. The bank tells you you're only paying 3.5%. But if you look over the entire duration, you might end up paying 850,000. And that's just because you've been paying so much in interest. So the interest payments over the entire period is roughly 450,000. So the most important thing you have to understand is how to finance, but also how to structure your duration and how to structure the choice of fixed or variable. We'll go back to this diagram. I'm going to share something, and please, this is not financial advice. Ideally, you should consult with an expert, someone knowledgeable about these matters before you make a decision. But I'll tell you what I have done in the past and what I will always do. Because I have studied financial markets going back the last 100 years, and because I have a keen interest in financial markets and financial history, and because I have an understanding about finance, I'm always looking at this market cycle. So today, when it's so cheap to borrow, and if you look at the Bank of England, and if you look at the Federal Reserve Bank, and if you look at the ECB, which is the European Central Bank, the Federal Reserve Bank had made it very clear that they will not increase the rate of interest, at least for I should rephrase, when the pandemic began, from March, they made a statement that they will not increase the interest rate for a 2-year period. In other words, they said the interest rates will stay fixed because the economy is not well. The Bank of England very quickly reduced the rates all the way down from, I believe it was 0.75. They took it down to 0.5, and then they took it down to 0.1. I could be wrong. Either this or it was 0.5. They took it down to 0.25, and then they took it down to 1. It doesn't matter. But all of these banks follow each other. And the reason is because if the rate is too low in the United States, capital will flow from Europe to the US, or from Great Britain to the US. As soon as the Fed reduced this rate, the Bank of England reduced this rate, the ECB bank reduced this rate, and all 3 banks have said it will stay fixed for about a 2-year period. What does that mean? It means if I were financing my investment opportunity today, I will not choose a fixed rate. You choose a fixed rate when you know that rates are about to increase. You choose a variable rate when you know that rates are about to stay flat or go down. Now, already the ECB is a negative interest rate. The Fed is considering negative interest rate. The Bank of England is talking about negative interest rates. Now, depending on what bank you choose to raise capital from, what this would mean, and this is what it used to be before, but some banks have made changes. If the bank is charging you 3.4% and a Bank of England borrowing rate of 0.1, which gives you 3.5%, if this goes to negative 0.5%, this would mean plus that your interest rates will fall to 2.9%. So historically, some banks have enacted rules now where they say we will not, if the Bank of England rate drops below 0, you always pay a fixed amount. And the reason was because previously there are times when the interest rate goes down where the bank is paying you for the opportunity to loan money to you. This is a simple example. In this case, the rate you're paying is so much less than the original bank rate. So most banks have made some changes. But the point I'm making with this is to suggest in times like these where they've said for the next 2 years, we do not foresee any increase, it's much safer to have a variable interest rate. On the other hand, if you were somewhere here and the economy was doing quite well, it could be very easily increased by the central banks, and therefore a fixed rate will be better. Like I said before, you want a fixed rate when the possibility and the probability of increase is there. You want a variable rate when the possibility of decrease is within the horizon. So I hope that's been useful. Let me, I guess, very quickly bring this to a swift conclusion. I would simply say this to you. When you're financing, recognize that the cost of financing plays a huge role in the value of the asset. However, you have to be prudent. Using 100% debt, in my opinion, should not be done without due consideration. And as a matter of fact, whenever you mix ignorance with borrowed money, you usually have disasters. Now, if this borrowed money is 100% and you're ignorant, you will have there will be some casualties. So you should always and only use debt with education and financial intelligence. If you do not have the knowledge, seek the knowledge, ask questions. But I would say with real estate, you have to be aware of all of the factors that influence both your staying power, in other words, you not going bankrupt, but also influence the success of your investment opportunity. In one of the earlier sessions, I talked about something called the margin of safety. This margin of safety simply means that you're making allowances for your errors of omission and errors of commission. You're making allowances for your shortfalls. You're making allowances for changes in the macro factor. So I've talked about the ECB, I've talked about the Bank of England, and I've talked about the Federal Reserve Bank. They've made all these promises, but they can renegade on their promises. So a margin of safety protects you from any unforeseen errors. And this simply means if you're using debt, you must allow for a huge margin of safety between your operating income and your debt interest rate. For example, you generate some revenue, you pay all your costs, that leaves you with operating profit. But you haven't paid your interest rate. If you're making £1,000 per month and your interest rate is 900, you have almost no margin for error. As a matter of fact, your margin for error is so small that all it takes is for something to happen to your revenue and you're in trouble. In other words, we'll go back to the what I drew before. Your interest payments, if your cash flow should fall below your interest payments, you're already bankrupt. Any of you who understands back in the day, who understands the Lehman Brothers crisis, it wasn't the failure of Lehman was not because they had no equity. Basic accounting equation. It was not because the liabilities they had exceeded the equity. No. Lehman Brothers crashed because he had a liquidity problem. And this liquidity had to do with the fact that he had interest payments that he had to make. It was obligated to make, contractually obligated to make, However, this assets that he had, at the time, the revenue he was generating, or the operating income he was generating, was not sufficient to cover the interest payments, and therefore he became solvent. So whenever you get to a point where the cash flow you're generating falls below your interest payment, you're in trouble. And that's the reason why the use of debt needs to be carefully considered. So that you should be checking and saying, well, even if I lost 50% of my cash flow, I'd like to be somewhere here. Because if I stay above the interest payments, I do not go bankrupt. I hope this has been useful. I wish you all the best.